Two percentages can describe the same sale and still be different. A seller might say an item has a 66.7% markup, while a report shows a 40% gross margin. Neither number must be a mistake. The two calculations can use the same gross profit but divide it by different bases. Markup looks back at cost. Gross margin looks at sales revenue. The denominator changes the percentage. Imagine Amina running a fictional weekend craft stall. She buys one plain canvas tote from a supplier for AED 72 and sells that tote for AED 120. These amounts, the stall, and the transaction are invented for this lesson. They do not describe a real business, tax rule, pricing policy, or personal recommendation. The example isolates one sale so the labels remain easy to audit. The first scene attaches two tags to the same tote. The orange tag says cost, AED 72. The green tag says selling price, AED 120. Cost is what this simplified example assigns to obtaining the tote. Selling price is the revenue from the sale before any other business expense is considered. Keeping those labels separate prevents the later percentages from floating without a base. Next, a ruler places cost at AED 72 and selling price at AED 120. The visible gap between them is AED 48. That comes from AED 120 minus AED 72. In this deliberately limited example, AED 48 is gross profit on the tote before other operating costs. It is not automatically net profit. Stall rent, payment fees, packaging, transport, wages, taxes, returns, or damaged stock could matter in a fuller business account, but none of those appears in this isolated calculation. Now calculate markup. The numerator is the AED 48 gross profit. The denominator is the AED 72 cost. AED 48 divided by AED 72 equals 2/3, or about 66.7%. The markup percentage answers a cost-based question: how large is gross profit compared with the cost assigned to the item? The cost base is why the percentage is larger than 40%. Gross margin keeps the same AED 48 numerator but changes the denominator. This time AED 48 is divided by AED 120 of sales revenue. The result is 40%. Gross margin answers a sales-based question: what share of the selling price remains as gross profit after the tote's AED 72 cost is recognized? Because sales revenue is larger than cost, dividing by sales produces the smaller percentage. A revenue partition makes that 40% visible without changing the arithmetic. The full AED 120 selling price splits into AED 72 of cost and AED 48 of gross profit. Cost occupies 60% of sales revenue, while gross profit occupies 40%. Those two parts rebuild the whole selling price in this simplified sale. This partition supports the gross margin view because the entire bar represents sales revenue. The denominator fork explains why the two percentage labels should not be swapped. One AED 48 gross profit numerator travels left toward AED 72 cost and produces 66.7% markup. The same AED 48 travels right toward AED 120 sales revenue and produces 40% gross margin. The numerator did not change. The denominator and the question changed. This distinction matters when two people compare prices, product categories, or reports. If one person says margin while calculating profit divided by cost, the label and formula disagree. If another says markup while calculating profit divided by sales, the same problem appears in reverse. A percentage without its base can sound precise while remaining ambiguous. Naming the numerator and denominator turns the statement into something another person can verify. The relationship can also be checked from the cost side. AED 120 divided by AED 72 is about 1.667. Multiplying AED 72 by that factor gives approximately AED 120. The tiny rounding difference comes from shortening the repeating decimal. This rebuild shows how a 66.7% markup means the selling price is about 166.7% of cost, not that gross margin is 66.7%. The four-field grid provides a compact audit. First label cost, AED 72. Then label selling price, AED 120. Subtract to find gross profit, AED 48. Finally, name the base before writing a percentage. Cost as the denominator produces markup. Sales revenue as the denominator produces gross margin. The labels do more than decorate the numbers, they define what the result means. There are boundaries to this classroom example. Gross profit is not the same as net profit, and gross margin is not a complete measure of business performance. A real account can include additional costs, inventory methods, discounts, returns, taxes, timing differences, and reporting conventions. The example does not claim that AED 120 is a suitable price or that either percentage is good or bad. It only demonstrates the denominator logic. The plain takeaway is simple: subtract selling price minus cost to find gross profit, then inspect the denominator before naming the percentage. Gross profit divided by cost is markup. Gross profit divided by sales revenue is gross margin. The same AED 48 can therefore become 66.7% or 40% without contradiction. This is educational only, not financial advice.